If you're watching this, you've probably already consumed hours of trading content such as chart and candlestick patterns, Fibonacci, no, not this Fibonacci, this one, moving averages, and a lot. But more likely than not, you haven't been taught how the market actually works. So here we have auction market theory. This is a simple concept that you've probably already know about, just maybe never thought of applying it to the financial markets. First of all, what's in the name? Auction is a public sale in which goods or property are sold to the highest bidder. Keyword, highest bidder. Market is a gathering of people for the purchase and sale of provisions, livestock and other commodities. Let's smash them both together, and we could say that an auction market is where people gather to purchase and sell products, where products are sold to the highest bidder and bought from the lowest seller. In other words, look to buy low and sell high. Normal rational behavior for most people, right? This same principle applies to the financial markets. I will explain auction market theory to you by first using a real-world example, followed by linking it to the financial charts and markets in part 2 of this video. In this example, our market is a two-way market, such as eBay, or if you're in Singapore, Carousel. Our product is the most efficient transportation on the planet, a bicycle. Specifically, this bicycle. The first question you ask yourself, whether you are a buyer or a seller, is how much does this bicycle cost? What is its fair value? So you probably trawl the internet looking for the price of this specific bike amongst other searches, and you discover that this bike goes for roughly 2.5k. Most of the bikes were transacted at a range of between 2.3 to 2.7k. So this price range could be considered the fair value for the bicycle. If you were to plot out the price of the bicycle against time, you would probably have a chart of something like this, which is a range. Plotting the number of transactions at each price, you will probably have something like this, where there is a lower volume towards 2.3 to 2.7k and more volume towards the mean. Now let's say Jamie received this bike as his birthday present, but guess what? He doesn't even cycle. He does a quick survey of the price and decides to get rid of it at 2k, selling clearly below fair value. He gets a ton of messages from buyers within 10 minutes as the bike represented great value for them. Needless to say, his bike was quickly sold. A chart of transacted price against time would probably be this, with a quick drop in price followed by a quick return back to the average price, and the number of transactions at such a low price would also be very low, as not many people would want to sell the bike so cheaply. Now let's say John's bike was stolen and he really needs a bike urgently, and he only wants this bike. He searched online, but the bike he wanted wasn't being sold. He then posted an ad saying, "Looking for this bike, 3,000. What do you think will happen?" People with the bike would probably look to sell it to him since they have a profitable opportunity. They could always buy the bike again later at the fair value price. A chart of price against time would probably show a spike higher, followed by a quick return back to fair value. And similarly as before, the number of transactions at that high price is very low compared to the fair value. So this is a scenario when the market is balanced. Prices are relatively steady, and people are happy to transact at that price range. When prices head towards the lower end of the range, buying is expected, and when prices head towards the higher end of the range, selling is expected. This is called responsive activity. It's what is expected under normal circumstances. How about when the market is imbalanced? When the market moves strongly in one direction, either up or down. Now we have a shift in the fundamentals. It's 2020 and COVID-19 is around the globe. On one hand, you have decreasing supply due to supply chains being disrupted, and on the other hand, people are starting to pick up cycling for various reasons such as exercise or a means for some fresh air during lockdown periods, and that drives up demand. This imbalance between low supply and an increase in demand leads to competition between the buyers. They increase their bidding prices and buy at higher prices, which drives up the price of the bike. New sellers, on the other hand, are seeing that the price of bike has been transacted higher and higher, so they in turn would increase their offer prices to obtain the best profit. This occurs up to a point where buyers are no longer willing to spend that much for a bike, which reduces demand. They don't see value in that bike at that price anymore. And prices will begin to drop until supply and demand are in equilibrium again. This is the new fair value in this new situation. As for the number of transactions at the price, this would likely be how it looks like. A large amount of transactions at the fair value, followed by okay amount of buying higher, but not as much as compared to the fair value, followed by another distribution at the higher price, which is the new fair value. In a balanced scenario, when the market breaks for higher prices out of value, selling is expected. But in an imbalanced scenario, buying occurs instead. This is called an initiative activity. Buyers are taking the initiative to drive higher prices. And you know what else takes initiative? Clicking the like button. This whole bike example I've been explaining is also what happens in the financial markets. It's what's happening in your forex chart, your futures chart, or your crypto chart. It's just much quicker and complex, since there are thousands of market participants, each one having their own time horizons, expectations, and objectives. So the price charts you see in your terminal is not some mysterious thing that moves up and down randomly and haphazardly. Price does not move up because the charts show a pin bar or a double bottom. Rather, it is because of the interaction between the buyers and the sellers, the aggressiveness in one side or the other that causes a supply and demand imbalance, which causes that chart pattern to form. So stay tuned for part 2, where we see how we can apply this concept to formulate trade ideas and expectations. See you there! P4Trading, out!